You already know how to cap risk, to size positions, to respect your stop. You can explain expectancy and why a small loss today protects your future. Yet, when the market jerks and your pulse ticks up, the mouse drifts, the finger clicks, and the plan dissolves. The gap between knowledge and action is not a gap in information. It is a gap in how your trading mind is built. Many try to fill that gap with extra indicators, more screens, more headlines. The result is noise, not control. Imagine opening your platform tomorrow with the same strategy but a different mind. The same charts and setups, yet a different sequence of decisions. Hesitation replaced by clear criteria. FOMO replaced by selective engagement. Hurt pride replaced by rapid loss ejection. This is not motivation. It is engineering. Today we start the rebuild. We will define how to frame probability without myths, how to practice patience without going passive, how to act with confidence inside uncertainty, and how to keep discipline when emotions bite. By the end, you will know the specific levers to set before a trade ever happens, so that your actions finally match what you already know. You will hear practical language and clear steps, not slogans, so your platform becomes a controlled workspace rather than a trigger. Here is the thesis. Results follow mental architecture, not intentions. A trader with the same strategy can live two separate futures depending on how the mind handles pressure, novelty, and randomness. When stress rises, the brain defaults to speed, not accuracy. We mistake urgency for opportunity, widen risk to relieve discomfort, and chase action to prove worth. The cure is to rebuild the architecture in 4 parts that govern behavior before, during, and after execution. Probability framing turns edge into a repeatable production process, so single outcomes stop ruling your mood. Strategic patience converts waiting into selective engagement, so idle time becomes work, not guilt. Confident uncertainty accepts that not knowing is normal, and designs exits, size, and scenario branches around it. Operational discipline enforces the rules under load through limits, pauses, and debriefs. The stakes are simple and high. Capital survives or it does not. Confidence compounds or it erodes. Expectancy is harvested or it leaks through impulsive decisions. With the right architecture, you cap loss, let wins mature, and remain steady across noise. With the wrong one, you oscillate between hesitation and compulsion, and every news spike reopens the same wound. Choose the architecture. Build it on purpose. We will convert feelings into procedures, define risk envelopes and position caps, build a layered stop design, and install cooldowns that prevent spiral decisions, so your actions remain consistent, testable, and profitable across changing volatility and unexpected events reliably. Probability is not a slogan. It is a way to build your work so that single trades stop deciding your mood. Treat your trading like a production line that measures yield across a run. Each order is a unit on the belt. Your system is the process specification. Your journal is the quality log. One unit can pass or fail for reasons that say little about the process. What matters is whether the line is in control. When you think this way, you stop arguing with one outcome and start protecting the process that produces many outcomes. You are no longer trying to be right today. You are trying to be repeatable over months. Start by defining a daily risk envelope. This is the most you will spend to learn today. Pick a number that your mind can truly accept. 1% of equity per day is a common ceiling. Then define a trade risk unit inside that envelope. Many traders use 1/4 to 0.5% per trade, depending on current volatility. Convert that into position size using the distance from entry to your hard stop. If the distance doubles, your position halves. If the distance tightens, your position grows but never beyond the envelope. If the spread widens beyond your allowed slippage, you reduce size again or pass. This keeps the process stable across changing regimes. Replace prediction talk with specification talk. A valid setup is not a feeling. It is a set of observable conditions that can be audited. Define allowed context like trend strength, volatility band, liquidity hours, and correlation with a higher time frame. Define disqualifiers like news within 10 minutes, a gap that breaks structure, or a drift day that compresses range. Before you click, you run the specification. If a required condition is missing, you stand down. If any disqualifier appears, you stand down. This is not hesitation. This is quality control. Install a variance budget so that randomness cannot drag you into reckless recovery. Decide how many risk units you are allowed to spend before you stop for the session. 3 units is a strong default when you are still training. If you hit that limit, you close the platform and switch to review mode. There is no debate after the 3rd unit is gone. The line is out of control for today. Tomorrow, the line restarts fresh. This single rule will erase most revenge spirals because the recovery attempt is blocked by design. Plan stop placement in advance and separate it from the heat of the moment. Use 3 layers. The hard stop lives in the platform and protects the envelope. The soft stop is a price zone where you evaluate whether the trade still meets the specification. The structural stop is tied to the feature that made the trade valid in the first place, like a swing low or a channel boundary. Place the hard stop first and calculate size. Place the soft zone in your mind and rehearse the exit so it will not surprise you. Place the structural stop on the chart so you know the proof of invalidation. If the structural feature breaks, the trade is over without negotiation. Write a short pre-entry probability brief to align your head with the process. Say it out loud so your body hears it. Say the setup name and the market state in simple words. Say the disqualifiers that would cancel the idea. Say the expected distribution of outcomes. For example, small loss most often, moderate win less often, large win rarely. Say the abort rule that will pull you out without drama. When you voice this brief, you unlink your ego from the single outcome and tie it to compliance with the process. Build 2 clear if-then lines that you will honor without delay. If the spread or slippage exceeds your limit, you either reduce size by half or you skip the trade. If the trade tags the soft zone and your reason for entry is no longer present, you exit first and explain later. Add 2 more that protect your variance. If you log 2 consecutive execution errors, you stop for 15 minutes and reset. If you win 2 trades in a row and feel euphoric, you cut the next risk unit in half to avoid overreach. These rules are simple, fast, and measurable. Measure performance with language that keeps you calm. Grade sessions by process, yield not by net profit alone. Count valid trades taken, valid trades skipped, and invalid trades taken. Track average risk per trade, average adverse excursion, and average favorable excursion. Aim to keep adverse excursion near your design stop and to let favorable excursion breathe longer. Review only what you can change tomorrow. If you cannot turn a note into a rule or a ritual, it is noise. If a note becomes a rule, update the specification and print it again. Finally, make single trades small enough that you can execute the next one without fear. Tiny risk shrinks ego. When the size is right, you stop narrating the trade as a test of identity and you start running the line. Most days will be ordinary. A few will be generous. A few will be harsh. The process smooths the sequence. You are not here to guess the next tick. You are here to produce a stable yield of good decisions that compound over quarters and years. Patience is not waiting around. Patience is selective engagement, based on predefined conditions that protect your edge and your attention. Think of your desk as an operating room. Nothing proceeds until the field is clean. The instruments are counted, and the vital signs are stable. You do not open because you feel like it. You open because every condition that makes the work safe and precise is present. Strategic patience is that discipline applied to markets. You decide what deserves your capital and your focus before the session starts, and you honor those criteria when the heat rises. Begin by defining readiness gates. First gate is your internal state. Check sleep debt, caffeine load, recent profit and loss swings, and any stressors unrelated to trading. Say out loud whether each is green, yellow, or red. If you mark 2 or more yellow items, you reduce your risk envelope by half for this session. If any item is red, you do preparation only, and you do not trade. Second gate is market state. Label volatility regime as compressed, normal, or expanded using your average true range on the anchor time frame. Write 1 sentence that explains what your setup needs in that regime. If the regime does not fit, you do not try to force the setup. Third gate is structure. Identify the clean levels you will use to define risk and a nearby structural invalidation zone. If the chart is messy and your levels are ambiguous, you delay engagement. Install a delayed execution toggle. When you see your setup, activate a simple timer for 90 seconds. During this pause, you run your specification. You confirm context, check disqualifiers like scheduled data within 10 minutes, and test that the order book or spread is within your allowance. If the setup remains valid after the pause, you proceed. If it degrades in any way, you stand down. This single pause converts a rush into a review and makes patience active rather than passive. Add a double confirmation requirement. The The setup must confirm on the execution time frame and align with a higher time frame cue you trust. Alignment can be trend direction, momentum slope, or a volatility shift that favors expansion. The two confirmations must be present together. If only one appears, you log the observation and wait. This blocks the common pattern where a single candle seduces you into early entry. Train your body to stay still while your mind evaluates. Use a quiet hands cadence. Rest your palm flat. Breathe in for 4, hold for 2, exhale for 4, hold for 2. Repeat 3 cycles. Keep the mouse still during the cycles. This prevents the click impulse while you check the gates. When you feel urgency spike, count 1 full cadence before any action. You will feel the window of compulsive energy pass. Turn patience into numbers. Set a daily trade cap that matches your strategy, frequency, and volatility regime. For example, during expansion, you may allow 6 attempts, during compression 4, during a transition only 2. Set a time and market cap so you do not loiter in marginal trades. For example, if a trade has not moved favorably by 1 risk unit in 20 minutes during liquid hours, you cut exposure to half and reassess. These caps make inaction a decision, not a drift. Use clear if-then lines. If you feel fear of missing out because price moves without you, then you open a fresh chart with no position and write 2 sentences that describe the structure you would have needed to act. If you have taken 2 trades that met your specification and both failed within your planned risk, then you reduce the next risk unit by half and require a stronger context alignment before any further attempt. These lines replace stories with switches you can flip in real time. Close each session by translating patience into a habit you can test tomorrow. Record the number of valid setups passed, the number taken, and the reason for each pass. Note the moments when the delayed execution toggle saved you from slippage or a marginal context. Pick one lever to adjust for the next session, such as increasing the pause length in choppy hours or tightening the definition of higher time frame alignment. Strategic patience is a skill you can practice. It is the choice to trade only when all gates are green, to delay when the mind is hot, and to reward yourself for restraint as much as for profit. Uncertainty is not a flaw to remove. It is a designed constraint to build around. When you accept that the next tick is unknowable, you stop trying to outguess it and start preparing responses that work across branches. Before the session begins, you sketch 3 simple paths the market could take for your setup: expansion in your favor, expansion against you, or stagnation. For each branch, you decide in advance what you will do with size, stops, and attention. In the favorable branch, you allow the position to breathe to at least 1 risk unit of gain before considering a scale out. In the adverse branch, you eject at the hard stop without negotiation. In stagnation, you cut exposure to half after a set time and market, and then decide whether the idea still fits the structural premise. This turns uncertainty into a prepared map rather than a surprise. Build asymmetry on purpose. Your average loss must stay smaller than your average gain. You enforce that by locking the hard stop at entry and using a soft review zone that lets you make an intelligent exit when the reason for the trade weakens. The hard stop defends the envelope. The soft zone asks whether the setup is still present. The structural level answers whether the original premise is broken. Use the 3 layers as a living system rather than a single line in the sand. Use them when volatility is high and direction is unclear so that you have a rapid exit, a thoughtful review, and a non-negotiable invalidation. Test them by reviewing 1 month of trades and checking how many exits happened at each layer and whether the average loss stayed inside your planned risk. Diversify how you express an edge so you are not hostage to one style. The same pattern can be expressed as a pullback entry, a breakout entry, or a time-based entry after consolidation. You can express it on a faster time frame with smaller size or on a slower time frame with fewer decisions. You can rotate instruments to avoid correlation clusters. Use diversified expressions when the market regime shifts and your primary entry feels forced. Test them by tracking win rate and average excursion for each expression, and then biasing future attempts toward the expression that delivers cleaner moves in the current regime. Install a risk envelope for each day and a smaller envelope for each session within the day. The daily envelope caps what you can spend to learn before you stop. The session envelope divides that total into clean blocks, so you do not blow the day during the first hour. Use envelopes when emotion is likely to surge, such as during major releases or after a large win or loss. Test them by auditing how often you exceeded the block and whether stopping preserved mental clarity for the next session. Write and read an uncertainty acceptance statement before the first order. Say that you do not control outcomes, only risk, process, and behavior. Say that losses are the cost of testing an idea, not a mark on your identity. Say that your goal today is to comply with your rules and allocate risk only when the specification is met. Use the statement when you feel the urge to force clarity out of noise. Test it by noting your heart rate or breath pace before and after reading, and by checking whether your first decision of the day aligns with the plan more often after adopting the ritual. Give yourself clear, if-then lines that fire quickly under ambiguity. If spread widens beyond your limit or liquidity thins, then convert the next order to a smaller limit order with a price boundary, or stand down until the book normalizes. If the structural feature that justified the trade breaks while the soft zone is tagged, then exit immediately and require a fresh setup to re-enter, rather than trying to fix the current one. If a news spike appears and you are not already in, then do not chase the first move and wait for either a measured pullback to your level or a full bar close that restores structure. If volatility compresses after entry and your time and market cap is reached, then reduce size to half and give the rest one more cycle to prove momentum. Manage partial information with order hygiene that respects uncertainty. Enter where your risk is defined, not where the chart looks exciting. Every adjustment has a reason you can state in one plain sentence. Use hygiene rules whenever you feel a pull to improvise. Test them by tagging each discretionary tweak in your journal and checking whether those tweaks improved or degraded expectancy. Treat the unknown as a partner that keeps you honest. When you plan for branches, size with envelopes, exit through layers, and speak your acceptance out loud, you stop arguing with surprise and start operating inside it. The market does not owe you clarity. It offers only opportunity mixed with noise. Your job is to convert the part you can shape into consistent behavior and to eject cleanly when the part you cannot shape takes over. Discipline is systems compliance under emotional load. It is the habit of doing what the plan demands, even when adrenaline asks for something easier. Build discipline as a set of guardrails that operate faster than your feelings. Start with maximum pain limits. Decide in advance that you will never add to a losing position. Decide the number of consecutive losses that stop you for the session. Many choose 3. Decide the daily trade cap that matches your edge and the current regime. Set a cool-down protocol for any surge in emotion. When to use maximum pain limits is when volatility is high or you notice urges to fix a trade. How to test them is by auditing a month of sessions and confirming there is not a single add to loser event, and that every hit of the loss limit triggered a stop for the day. Install a consecutive loss stop that triggers a reset. If you take 2 losses back to back, and either one was due to an execution error, then you step away for 20 minutes, drink water, and reread your one-page procedure before the next attempt. If you take 3 consecutive losses with clean execution, then you close the platform and shift to review mode for the rest of the session. Use this when your mind starts seeking relief through action. Test it by checking whether post-pause trades return to specification, compliance, and whether the distribution of outcomes stabilizes after the reset. Define a trade frequency cap so boredom cannot push you into low-quality attempts. Pick a number that fits your method and the regime. For example, 6 attempts on expansion days and 4 on compression days. If you reach the cap without positive process yield, you stop and convert the rest of the day to study. Use frequency caps when the urge to stay busy rises. Test them by comparing expectancy on days when you obeyed the cap versus days you exceeded it in the past. Create a one-page trader operating procedure and keep it visible. Put your setup specification, risk envelope, variance budget, stop architecture, if-then lines, and end-of-day checklist on that single page. Use the page at decision points so the brain does not have to recall rules from memory. Test it by scoring compliance for each decision on a simple yes or no scale and targeting a weekly compliance score of at least 85%. If the score drops below that level in any week, you reduce risk by half until the score recovers. Add a cool-down protocol that interrupts spiral behavior. If your heart rate surges or you feel a heat rush after a loss or a win, then you remove your hands from the keyboard, stand up. Breathe a quiet hands cadence for 1 minute, and write 1 sentence describing the last decision in neutral language. Use the protocol after any emotional spike. Test it by measuring the time between trades before and after the protocol, and by tracking the error rate on the next 2 decisions. Shift your attention from profit to decisions by using a post-trade debrief that focuses on behavior. Record whether the trade met the specification, whether size and stop matched the plan, whether the exit was at the planned layer, and whether any discretionary tweak occurred. Write one improvement you will test next time that is under your control. Use the debrief after every trade, win or loss. Test it by confirming that each note can be turned into a rule or a ritual and by pruning any notes that cannot. Give yourself clear, if-then lines for discipline maintenance. If compliance for the day falls below 80% by noon, then you reduce all remaining risk units by half and take only A-grade setups. If you break any hard rule, such as moving a hard stop away from risk, then you end the session immediately and complete a written post-mortem before you return the next day. These switches keep the system in charge when emotions get loud. Discipline grows when you measure what you did, not how you felt. When the guardrails are clear, the procedure is visible, the cool down is automatic, and the debrief turns into rules you can test. Your actions stop drifting and start repeating. You will feel calmer because the system makes the decision before you do. Start each day with a short calibration that sets your risk, your focus, and your boundaries. Label the volatility regime on your anchor timeframe as compressed, normal, or expanded, and write how your setup behaves there. Mark your daily risk envelope as a ceiling, and divide it into session blocks so the first hour cannot drain the day. Note key levels you will respect, the structural invalidation for your primary idea, and 2 scenarios that justify switching. Confirm readiness by checking calendar, connection, and spread limits. Read your acceptance statement, breathe a quiet hands cadence, and open the workspace with only the charts and tools required by your specification. During the session, let a simple checklist cue every action. Is the setup present? Is the context aligned? Are disqualifiers absent? Is size computed from the stop? Is the order type chosen for current liquidity? Place the order only after the delayed execution toggle has expired and the setup still meets specification. Once in a trade, practice order hygiene. Do not widen hard stops, do not add to losers, and adjust only for reasons you can state in one plain sentence. Respect time and market caps by reducing to half if progress stalls and by exiting if the structural premise breaks. Protect attention with a distraction plan. Silence non-essential feeds, set a 5-minute review chime, and keep your phone out of reach. If emotion spikes after any result, run your cool-down protocol before you consider another decision. After the session, run a short debrief focused on behavior, not outcome. Record which trades met specification, which did not, where size or stops drifted, and whether the delayed execution toggle or the pause saved you from error. Capture one pattern you observed in the market and one behavior you will adjust tomorrow. Tag any discretionary tweak for review next week in scoring. Choose exactly one improvement rule for the next session, state the if-then trigger, and reduce risk by half until compliance returns. Close by, resetting charts, archiving notes, and writing a single sentence that defines success for tomorrow's opening decision. 3 fast myths keep traders trapped before they even act. The first myth says, prediction comes first. In reality, expectation math comes first. You define risk and payoff, and let sequences reveal the edge. The second myth says, more trades mean more opportunity. In reality, more attempts without selectivity dilute attention and inflate costs. Selectivity raises average quality and lets winners breathe. The third myth says, a clever mind can outsmart a loss. In reality, losses are the price of running the process and deserve a clean exit. Pride turns a paper cut into a wound. Replace prediction first with specification first. Replace busy days with selective engagement. Replace fight the loss with loss ejection on cue. These swaps shrink noise, protect capital, and keep the mind steady enough to execute the plan that you already trust with calm consistency. You have rebuilt the way you trade by design. Probability framing turned a single outcome into one unit in a longer run. Strategic patience made waiting an active choice with gates, pauses, and alignment. Confident uncertainty accepted what you cannot control, and wired exits, envelopes, and layered stops to protect what you can. Operational discipline kept the system in charge when emotions pushed for speed. Take one ritual from today and install it before your next session. Read your acceptance statement, set your daily envelope, and place the one-page procedure where your eyes land before every order. Pick one if-then line. You will obey without debate for 7 days and write it on paper so your hands remember it. When the urge to chase appears, breathe the quiet hands cadence and let the timer expire before any click. This content is educational and is not financial advice. Markets involve real risk. Only trade with capital you can afford to lose. If this helped you steady your execution, subscribe to Mind Over Markets, comment with the one rule you will test this week, and watch the follow-up on turning your operating procedure into a printable sheet you can use every day.